Since I've had some requests to do an oil tanker update, I decided to bring the only Calvin for an interview to give us an update, and I thought it was the best way to do this. Calvin is the owner of two websites, tankerdata.com and marhelm.com. Both of these websites are in the description below. If you are new to this channel, my name is Mariusz Konieczny, and I run Microcap Explosions, which is a private membership website where I focused on small and microcap companies. I'm also the author of 10 books on investing, one of which is available at microcapexplosions.com. Mostly on this channel, I cover my three biggest positions, which are Oracle, Voxter, and Globex, and I have a video series on those three companies, and you can access them through the playlists on my YouTube channel. With that being said, let's go ahead and get started with the interview. Calvin, thank you very much for joining me.
Thank you for having me.
If you could take a few minutes, Calvin, maybe introduce yourself to my audience, who you are, because some of my listeners are new and they might not know who you are.
Okay. Well, I run marhelm.com and tankerdata.com. I'm a shipping investor, just investor in general. I have a real estate business in Panama. And so I've been living internationally and investing mostly in shipping companies for about the past 5 years.
Okay. Some of my listeners were requesting me to do an update on oil tankers. And as you and I remember, oil tankers were very hot. A lot of people were talking about them during the COVID because of the shutdown, and the oil was going on the tankers, and this brought a lot of attention. And I'd say right now it's not as much talked about, but people want to know, like, what's going on with the tankers.
Well, I would say that the big theme in tankers right now, or really the oil markets in general, is just that the oil market seems to continue to be very undersupplied. So you've basically got continued stock draws, not just in the U.S. but on a global level. So we're essentially back at 2017 levels of inventories, and we continue to draw very quickly. You've got a lot of supply outages recently. Libya had some outages. Kazakhstan, there's some civil unrest there that could affect also more than 1 million barrels a day worth of production. So you've really just kind of got this theme where during COVID there wasn't enough investment, and also due to ESG there just wasn't enough investment in oil production capacity. And so now, the world's oil inventories are getting drawn about as quickly as they ever have been. I think the estimates are around 3 billion barrels of oil total in global inventories, which sounds like a lot, but to kind of put that in perspective, the U.S. Strategic Petroleum Reserve right now is at a 20-year low. Some of the floating storage inventories in Asia that basically were there to assist with the IMO 2020 changeover, and then also when a lot of Asian countries bought cheap oil during COVID, when oil got shut in and WTI went negative for a moment there. Most of that oil has been consumed. So you've essentially got this situation where the tanks, they're not approaching empty, but they are the least full that they've been in as long as anyone can remember, at least in recent years. We're basically now starting to approach decade lows in global oil inventories. So obviously for oil tankers, it's more of a function of oil supply. So if oil supply is not, is kind of not meeting oil demand, it is a short-term negative for oil tankers.
So when you're talking about, the inventories being drawn down, do you have a sense of where the oil demand is? Because I remember the figure of 100 million per day of demand.
Yeah.
And then we dipped down during the COVID. Like, where are we right now?
So, what you usually get after a pandemic is higher per capita oil usage. Okay, higher per capita energy usage in general. So you can observe this in a lot of different markets and a lot of different examples. For example, after the SARS-CoV-1 outbreak in China, after the Hong Kong flu back in the 60s. There are different examples of where a pandemic actually spiked energy usage because people's habits change. Okay, so people stop taking public transportation, people start preferring their own transportation. People want to drive more instead of be on the bus or be around other people. So even if you have a fewer number of people in absolute terms driving, because 6 million people have died in the pandemic, and a world population is still growing, so that maybe that's not even fair to say, but a lot of the growth, of course, is newborns. So after a pandemic, you pretty much always get higher per capita energy usage, and even without jet fuel being back to where it was before the pandemic, the air travel numbers are the ones that are still lagging. But in pretty much every other sector, in most countries, you're back to or exceeding pre-pandemic levels of demand. So all in all, and you can look at the EIA numbers, you can look at OPEC numbers. All in all, the assessments are that already we're back at about pre-pandemic levels of demand, so 2019 levels of demand. And a lot of the forecasts are that the demand is going to hit as high as 102 by the end of this year. So it's definitely a mix of demand has come back faster than anybody thought it would, and supply production specifically has not come back as fast as people thought. So, we're essentially right now just burning our savings, burning the oil that we have stored, rather than producing enough new oil to meet demand.
That's interesting that you're saying that, because okay, we are pretty much pre-pandemic demand, right? And then that
Without
demand,
air
right?
travel
That
being
demand
yeah.
that demand is satisfied by production and savings, which is what you said in the
Yeah.
storage. And what you're saying is that right now, the production levels are not very high, so we're burning through our savings. So the
Mhm.
way I'm reading it is just a matter of time before we draw down those savings so low that we're going to have to
Price
kick in.
goes
Yeah, we're going to have to kick in from the production, and the
yeah.
production is really what you're saying, what's important for the oil tankers, because once you have production, then you have to transport this oil, and that's where the oil tankers come in.
Yeah, well, it's just kind of different dynamics. I mean, you tend to store oil close to refineries, right? Like the largest point of oil storage, I think, in the world is the U.S. Strategic Petroleum Reserve. I might be wrong on that, but it's definitely in the top three. So the U.S. Strategic Petroleum Reserve. I mean, look how close it is to most of the U.S. refining complex. The largest portion of U.S. refining capacity is located in that Gulf region: Louisiana, Texas, Alabama. That's where the majority of, or not the majority, but the largest subset of U.S. refining capacity is right along that little strip, and that's also where the Strategic Petroleum Reserve is. So now things have been a little bit better for clean tankers than dirty tankers, but I think what you're going to see is these inventories continue to get drawn down. Oil production continues to lag. Now OPEC thinks that supply is going to come roaring back this year. The EIA said that the supply is going to move back to oversupply in Q1. I was, more hopeful that was going to be the outcome last year, but kind of the closer we get, it's kind of like, okay, well, oil supply is still kind of lagging. So now the good news for tankers there is that if the market stays weak later, but demand stays weak longer, but demand is there, right? Like if supplies are getting drawn, demand is there, then it's just a matter of time until the market gets strong again. But in the meantime, you've got these environmental regulations, the new ones coming up later this year, EEXI. So a lot of older ships are going to have to get scrapped to meet those environmental regulations. And if oil production is still lagging oil demand by quite a bit, which it is, then the tanker market will be weak in the short term. So the kind of I think the most ideal scenario for tankers is that it takes longer than anybody thinks it does for oil production to catch up to oil demand. The crude tanker market especially stays weak in 2022. A lot of scrapping occurs. A lot of scrapping occurred last year, but if we get another year of weak rates, then you could get even more. And then with these environmental regulations coming into force, the oil price, if this scenario plays out, will probably go triple digits.
What about you said that there was a lot of scrapping, which many people were waiting for that to happen. So it's nice to hear that there was a lot of scrapping last year. But what about the order book?
Well, if you look at net fleet growth and you look at the total order book, I have the order book stats on my site, and I have charts per vessel class, so you can see exactly how it breaks down, what's on delivery, what's under construction, what's awaiting delivery, what's been canceled. Then you can break that down. So to put it in perspective, the total tanker order book, I believe, is around 8%. Okay. To put that number, and then last year you had scrapping in 1 year of more than 2% of the fleet. Okay. So last year, deliveries outpaced scrapping, but only by a little bit. So the fleet, really didn't grow, and in the meantime, it's a year older, and with these environmental regulations coming up. So if you consider that the order book is essentially spread over the next 2022, 2023, the next 4 years basically, right? And you look at where orders are going now across all vessel classes, pretty much every delivery now is for 2024, and they're stretching into 2025. I've seen deliveries as far out as 2027. So the order book is getting very, very crowded, but the majority of those orders are not tankers. They're containers. The dry bulk order book is growing, though it's still at very low levels. The LPG and LNG order books are enormous.
The shipbuilding capacity is pretty much constrained if you're saying that the other product types are keeping them busy.
Right, and shipbuilding capacity is also a lot less than it was during the last big ordering boom, which was back in the mid 2000s, like 2008, 2010. There are fewer shipyards in operation, and more shipbuilding capacity is being reserved for military use. So a lot of the shipyards in China, they essentially can't be utilized for building ships because the Chinese government is saying, okay, well, we need this capacity free and available if we need to start pumping out a bunch of warships. So I think from if you're looking at kind of vessel supply dynamics, I think things are more favorable in tankers and dry bulk than any of the other sectors by far. The container order book is massive and growing every week. The LPG and LNG order books are also very big, but LNG had a lot of scrapping last year as well. Mm-hmm. So anyway, I think you're going to see, with steel prices as high as they are, I think you'll see above average scrapping over the next year in most vessel segments. I think as an older container even rolls off of a charter, and as new deliveries start coming in, I think even container scrapping can start picking up, even though the rates are really high at the moment. I think they'll be a lot lower a year from now.
You said that uh, product tankers are doing better than the crude tankers. Is it because for the product, when you for the refineries, when you take the crude to refine it to a product, you don't care where the product comes from, whether it comes from production or whether it comes from storage.
Right,
Is this why?
exactly. Yeah, basically. It doesn't it matters really more what the pattern is around fuel exports, right? Because crude oil tends to get imported into refining complexes, and then fuel gets exported. So there's been a lot of refining dislocation. The product order book is also tighter, a lot tighter than the crude order book. So I think that in some ways, product is kind of a little bit more insulated from the lack of oil supply than crude is. But both are affected. But if you look at the clean versus dirty rates over the past year, and you look at some of the specific company performances, like Hafnia and Torm were both cash flow positive last year.
And their product
Yeah, they're
companies.
product tankers. And they did that essentially without having charter cover. So without having gotten long-term charters, that kind of went through 2021. So if you look at, just kind of like the index charts of where clean and dirty tanker rates went last year, clean and dirty tanker rates actually finished the year significantly higher. Now Q3 was terrible. Seasonally, Q3 is usually a weak period, and then as Q4 starts coming in, you start seeing some trends which were really pretty strong this year, like the gas to oil switching, burning oil for electric production, and then the heating oil demand. So in the northern climates, a lot of countries still have essentially boilers that burn fuel oil to heat buildings, etc. So that's why you usually see a stronger tanker market in Q4 and Q1 than you do in Q2 and Q3, because oil demand is just kind of structurally higher in the winter, in the colder months, than it is in the summer months. In the summer months, you get higher. In Q2, Q3, that's the summer driving season in the U.S., for example, in Europe. So you get kind of higher fuel demand then, but you usually get higher oil demand in the winter months.
Yeah. Give me an idea of what kind of daily rates, the crude tankers get right now.
Well, it really depends on the configuration of the ship. Basically how old it is, what size the ship is. But to just throw out a couple figures, VLCCs, like a normal VLCC, not with a scrubber, not eco. So, kind of like let's say a 2008 Chinese built VLCC could be making $3,000 a day right now, which is very low. But an eco VLCC with a scrubber, built in a Korean yard, from last year, 2019, maybe they could be making 20,000 a day. So,
And what about Suezmaxes?
yeah, so the Suezmaxes, pretty close to the same figures, a little bit lower. There's actually some strength out there in the Aframax market right now. The average is quite a bit higher for Aframaxes. There's some route out there that Aframaxes are making, around 30K a day. The clean product tankers and dirty product tankers, those are actually earning a whole lot more right now than some of the larger vessel classes. So your handy size kind of intercoastal trade stuff. So there's actually quite a bit more demand for the smaller ships, and I think again you can attribute this in a lot of ways to just the different dynamics in the oil market right now. It's not so much export driven with high supply. It's kind of like dislocation based. So you're seeing a lot of these kind of rate flare ups in specific places or specific types of vessels. Right now, every product tanker is out earning a VLCC right now.
Yeah.
And these are much, much smaller ships.
For anybody that probably is betting on the oil tankers right now, the way they're looking at it is like what you said. Eventually, we're gonna work through the savings, and eventually the production is going to have to go up, and as a result there will be more demand for transportation, and then the daily rates for those ships will go up. And when that happens, like which companies would you be inclined to bet on in the crude space and also in the product space?
Well, I am betting on some of those companies now, but just to say it in a slightly different way, I think in a lot of ways shipping is always an asset play. So you're thinking about which type of ship has the highest probability of increasing in value. So when you've seen often people quoting, oh, the shares are trading at half of NAV, or the shares are trading at NAV. Well, the biggest factor in what NAV is the value of the fleet, right? So when you're looking at sensitivity and intrinsic value, it really all comes down to where the asset values are going to go. Now, I think with something like containers, the asset values are going to go down. You've got new charters, being done at lower rates than previous charters. If you look out like 3 years, 5 years out on the curve, the charters being done are much, much lower than current spot rates. So, you've got a couple components of a vessel's value, right? One is the steel content, and then the other is the charter value. So I don't have a super strong opinion on where steel prices are going to go. They're historically pretty high right now. But I can tell you that, if you look at the forward curve on charter values for a specific vessel segment, and you see that future charter values are higher than the current spot market, that's usually a decent indication that that's basically the market saying, okay, well, vessel values are going to go up, vessel values are going to go down. And so if you look at, tankers right now, the 1 year, 2 year time charter rate for most vessel classes is significantly higher than the spot rate. Most people think that it really just is a matter of time until the oil price goes high enough that production comes back online. Now, this is going to come in two forms, either in, people basically using the wells that they've drilled already, like, they have been using some of these in the US, versus, making new fields. But I think that if there will be a supply response to high oil price. And I think that this $80 oil price that we're seeing right now, even with, the different variants, with SPR releases, with all these different factors, the oil price has been really sticky. And that's because, the big money oil people out there can see that we're drawing more oil than we're producing, right? So the trend is towards scarcity in oil. So as far as, how to bet on specific tankers, I think you kind of have to group them into two categories. You've got the essentially the companies with super new fleets, super modern fleets, that are not losing money right now. So maybe they're even gap profitable right now, but they're not losing money on a cash flow basis. So they're adding cash to their balance sheet. So those would be, companies like Hunter Group, which is only like for very modern VLCCs, eco scrubber, Okeanis, eco tankers, kind of, in that category as well. I would say those guys are kind of like the top tier. No matter what happens in the next 6 months with the market, those guys are still going to be at least breaking even. So those are kind of your survivors, right? Those guys are definitely, they're not going to have to dilute. They're not going to have to sell ships. They're going to, they're still going to be there in a year from now. And at that time, they'll probably have a lot more spot exposure. So like Hunter Group, they have been making money during this entire time post-pandemic, right? I mean, you heard that it's going to be a disaster for every oil tanker company out there, right? That was the narrative during when the contango was coming off, right? Well, there are some tanker companies that not only didn't lose money since that happened, they've actually made money since then. So that narrative, you couldn't do it one size fits all. Now, on the other hand, you've got some companies like, Nordic American Tankers, TK, INSW. Some of these guys have varying levels of governance quality, but they all have old fleets. And, anybody with an old fleet is going to suffer disproportionately in the short term if the markets are weak. Now, that being said, I think that there are a lot of reasons to own NAT or to own INSW. So NAT is, usually trades at a NAV premium, and it's trading at a huge NAV discount right now. It kind of, even though management is selling shares because they're losing money and they need something to stay afloat, it's still, I think the whole space kind of represents a decent long opportunity just because you're starting from such low levels. INSW has shown that they're willing to sell ships at NAV and buy shares at 40% of NAV, which they've done repeatedly this year or over the past year, especially in the last 4 or 5 months. So I think that you've got different bets on different parts of the spectrum. On the most immediately sane, least downside stuff to do is the companies that have the newer fleets and they're not losing money. Even if you get another year of bad rates, it's just going to make the market better for them because we know that demand is there. And if demand is there, it's just a matter of time till supply comes back. I mean, unless we've really reached peak oil supply and we're going to hit some Mad Max world, which I don't think anybody thinks that's going to happen. It's very likely that oil production is going to come back.
Where do you put companies like Euronav and Frontline?
I would put them somewhere between the two. I would put Frontline and DHT maybe a little bit closer to the first group of the Hunter Group and the Okeanis, and I would put Euronav a little bit closer to the second group. Euronav is a great company, very well run. They're good at knowing when to take a risk and knowing when to back off. They've got a good shareholder return policies, high dividends. They do buybacks. They bought back I think about 10% of their float in the contango boom. So I would say Euronav's definitely a decent bet to make. I think the safest bets are the guys with the most modern fleets. Because while, like if somebody has a 15, 17-year-old ship out there, they're losing money, right? If it's not on a profitable time charter, as soon as it comes off that time charter, they're going to scrap that ship. It just does not make sense to operate a 15-year-old, 17-year-old ship right now. Last year we saw a 2009 Aframax get scrapped. Right. That's it's not even a 20-year-old ship. It was like a 11-year-old ship. So I think that, you are definitely going to see a lot more scrapping in those older ship classes. And if you look at, when a lot of those ships were built, 2002 to 2005, there was a big kind of tanker building boom then, especially in like the VLCC segment, for example. So there's a lot of scrapping candidates out there. Even, that's why I always, when I hear people talk about, the fact that new tankers are getting delivered, I'm like, well, new ships in every vessel class, in every shipping segment, everywhere, always have new ships getting delivered. The question is the fleet growing or shrinking? And last year, the tanker fleet barely grew. This year, I think it, could actually shrink based on the amount of scrapping that we get. You've got, a good number of VLCC deliveries. I want to say off the top of my head, it's around, I think there's, so right now you've got total on order in the VLCC segment, and this is like over the next 4 years, is like 67 units versus a total fleet size of 847. And then last year alone, you had about 20 VLCCs get scrapped. So if you think about at that scrapping rate, you're probably going to have about as many VLCCs delivered as scrapped. And there are, there's 67 VLCCs on order versus, there are over 100 scrapping candidates. Like there are over 100 ships that are likely to be scrapped. So, if you get at least as many ships scrapped as delivered, the fleet shrank. So I think that there's, it's not 100% chance, but I think there's a decent chance that the VLCC fleet could actually shrink in the next few years. And people keep saying, look at the deliveries, the deliveries, which is true if you're only looking at the deliveries, but you got to look at what's getting scrapped and what's likely to get scrapped. And the scrapping rate is, is high. I mean, it's in kind of relative terms. If we just look back at, a chart going back to 1990, which I have on my website, then, in 2021 was one of the 5 most active scrapping years in the last 20 years. So, there was a lot of scrapping.
You were talking about product tankers, and you talked about different stocks and how to play it. Do you have the same categorization on the product side?
Yeah, so I would say on the product side, and that thing that sounds like a cow in the background, by the way, that's my dog. I would say on the product side, I would put Hafnia and probably Hafnia and Torm in the kind of the top tier. These are the guys who are not losing money. They don't have any kind of balance sheet or liquidity concerns of any type. They're cash flow, positive. And then I would put on the other kind of far end of the spectrum, like Pyxis Tankers, for example, Ardmore, Scorpio, those guys would be in between somewhere. INSW would be in between, maybe, more on the Pyxis side of the spectrum. So again, INSW, while they've been losing a lot of money, they've got a huge, padding with their balance sheet, and they've been using that balance sheet padding to, to basically sell ships and buy shares. So even guys that are losing money, I think if you're getting them at a big enough discount and they're also doing the right things, I think you've got a lot of downside protection.
Calvin, thank you very much for this update. Tell us again your website, what you offer before we finish up the interview.
Yeah, so right now there are 2 websites, tankerdata.com and marhelm.com. The Marhelm is going to supersede my previous websites, but you can still sign up at either. So we publish daily spot rates. We display order book stats. We have a chat for shipping investors that's frequented by people that actually work in shipping. We have all of the ships getting sold on a monthly basis from all sources. We have updated scrapping stats, updated new building stats for every sector, broken down by status, whether it's under contract, whether it's pending delivery, under construction. We've got a fixture explorer that allows you to really dig deep into the tanker and dry bulk markets and see, where cargoes are coming from, where they're going to, who the charterer is, who the owner is, what rate they're being done at, what cargo they're carrying, whether it's gasoline or crude oil or whatever, jet fuel, aromatics, condensates, coal, iron ore, bauxite, grains. So lots of different stats. And then we also do a weekly roundup, essentially saying, okay, well, this is what happened in the past week in the different shipping sectors. Here are some interesting things, interesting deals that got done, maybe changes in the steel price, some what scrapping occurred. What are some kind of mean reversion trading opportunities for the next week, because we look at 45 different stocks or something. So it's a pretty broad range of coverage of the shipping industry in general. And right now, it's $600 a year, and I believe they get a discount if they use coupon code Marius. Then it's still a pretty good value. Versus some of the other services that allow you to do similar types of explorations that cost thousands or tens of thousands of dollars per year. So right now, I think it still offers really good value, but the subscription price is going up. We increase the price every couple of months as we introduce new features, because we just want to make sure that the members that we have, that we're not diluting the value that we're providing. So that's why we keep increasing the price.